gold is, I've got this interesting graph of gold and inflation from, it's a very long time series, almost 1,000 years time series. And it's amazing that the real price of gold hasn't really changed that much. You think, gee, $1,300 an ounce is a lot, but once you adjust for inflation over the long term, it's basically tracking inflation. Now, this is the problem, that there can be a deviation of gold from inflation. And if you want it as a hedge, you usually want it for a hedge like next year or right now. Maybe I'll wait 2 years, but you're not prepared to wait 100 years, right? So you need to be very careful here that, yes, it is the case that over the very long horizon, gold has provided some of a hedge. So basically the real return is zero. But you need to be careful because it might not perform as the hedge in the short term as you expect. So it is a huge mistake, in my opinion, to take an undiversified sort of bet on something you think might be an inflation hedge. So to go to your portfolio and buy gold thinking that's going to be my inflation hedge, it is a serious mistake. So you can do much better than that. Again, go through the commodities and you could actually estimate the beta of the commodity price change versus unexpected inflation. And you can see which commodities are the ones that are effective and the ones that are not effective. And again, you need to be careful doing that because that beta or risk sensitivity is going to vary depending upon where you are in the business cycle. Okay, so you need to take those two things into account. So the two things being different commodities have different inflation betas, and those betas on the individual commodities change through time. Once you have estimated that, then you can optimize a portfolio that's got the best possible inflation hedging chance, given all of the data that you've actually got. So I do think that this is increasingly popular. I think that a lot of people have piled into commodities kind of naively. Say, well, I need to buy a commodity, so let's buy the GSCI or something like that. And they're, losing a lot of money because that's just not a recommended investment vehicle. The GSCI is 70% oil, so you might as well just buy oil. You might as well just do what I told you not to do, to take an undiversified bet on one commodity. So that doesn't make any sense. And also the way that they construct the index, it really causes a lot of stress in terms of they look at only a couple of trigger points for rolling the contract, and you just throw money away doing that. So it's much better to look at the whole term structure of liquid commodities when you do the roll. If you get killed on the roll, then the index is not going to do that well as an investment. So I see, so basically more and more institutions are seriously looking at commodities as part of their portfolio. And it's also the case now that the retail investors got a chance of going in and putting commodities into their 401k or just regular portfolio.